Our featured guest, back with us, Nick Calamos, the co-chief investment officer over at Calamos Asset Management. So, Nick, let's start with you. Great year last year for stocks, not too shabby today as well. Where do you think we go from here?
Well, I think we're going to have a good old-fashioned recovery in earnings here that can propel the economy. For the most part, there's good operating leverage in earnings, and also we see great balance sheets in general in corporate America. So, we won't get any PE expansion here, but we should see economic profits generate a decent economic environment and ultimately higher stock prices.
Hey, I wonder, I love that you say you're short-term bullish and long-term scared. How short-term and how long-term? I mean, when do you make the switch here?
We're hoping that some common sense starts to prevail in Congress, and the spend our way and borrow our way to prosperity ends soon, because clearly that doesn't work in a business or in a household, and it definitely will not work in an economy either. Japan's got 20 years of that policy to prove it. So, we're very cautious here, and we're moving to higher quality balance sheets. But economic growth generally comes from profits and the reinvestment of profits here. So capital spending should boom, and we should also see some type of move here to rebuild inventories. So in general, we have a good short-term backdrop, maybe the next 6 to 9 months. After that, it really depends on what happens at the Fed and with Congress. They're in control.
Hey, Nick, let's talk a little bit about housing. A lot of folks talking about it, as Suzanne mentioned here. I mean, when you see more negative news in the housing sector, do you kind of write it off and say, we know it's going to still continue to be bad, or do you say, I got to watch this one?
We just popped an asset bubble here that was financed by the banks, and unfortunately, it's unproductive assets that has been financed, that they financed. So this is going to be a long workout period for the real estate environment and housing, and we expect another 3 or 5 years of pretty poor environment for the housing stocks in general.
3 to 5 years is a long time. I mean, I wonder what you think about all of the other assets that are now appreciating. Are we looking at some real bubble creation, some dangerous bubble creation, in your opinion?
I think the likelihood is high. The Fed is easing and concerned about the drop in the velocity of money, obviously. And they're going to continue to ease and quantitative ease here until the velocity of money picks up or some bubble occurs. And most likely, we're not going to get inflation in CPI and PPI. It's most likely going to go into financial assets. And, of course, they're directing it there right now. They're buying government bonds and agencies and mortgages, and then issuing more money to pay for that. So clearly, we're setting up for the potential for a lot more bubbles.
Looking for Nick, for unemployment. I mean, a drop of 1,000 is really no change, right? And Dean Mackey, we were just talking to, he is the most optimistic economist out there, but also the most accurate for 2009. He thinks we're going to actually finally add jobs for the month of December.
The unemployment numbers are very, very volatile and subject to big revisions. If we look out longer term, structurally, we'll probably see higher unemployment than we're used to, at least over the past 15 years. When an asset bubble financed by banks with as much leverage as they used pops in unproductive assets to boot, we're going to see it's going to take a while for this economy to feel normal again, and unemployment would be structurally higher probably again for the foreseeable future.